Good morning, students. Welcome back to the session on accounting. So today we are going to continue with our discussion on consolidation. In the last session, we started discussing about the consolidated balance sheet. We also discussed about the adjustments which are required by preparing the balance sheet, which was in terms of eliminations over and above the goodwill adjustment that we are required to pass, over and above various other adjustments which we are required to consider. Okay, but all through while preparing the balance sheet, one aspect which we have always ignored is about the profit and loss. So you can see the statement of profit and loss of all the group companies. So now we will move on to the preparation of this consolidated P&L also. After which we'll get this complete understanding as to how this consolidated financial statements will be done in terms of its in terms of its two important components, that is about balance sheet and P&L. Now, talking about P&L or talking about this consolidated P&L, the approach that we are required to follow again is not going to be any different from what we have considered in case of balance sheet. It's going to be exactly similar. That over here again, we need to do a line by line addition. All the line items of statement of P&L, that's the holding and the subsidiary, will be added. But certain eliminations are required to be captured. Okay? One of those eliminations was about the intercompany transactions in terms of purchase or sale of goods. Similarly, there could be any sort of transaction which may arise between the holding company and the subsidiary, which is required to be eliminated. So now we'll talk about those eliminations arise in case of P&L also. Okay, so now we are going to focus only on the consolidated statement of P&L. Now we can move on to this illustration number 12 on page number 10.51, please. We move on to illustration number 12. Okay. We are discussing consolidation. H Limited and its subsidiary provide the following information for the year ended 31st March X3. H Limited and S Limited, we have this information about the two companies. If you look at this entire information, this is all about the components of P&L: sales, change in inventory, raw material consumption, wages, production expenses. All of these components are made of it. Other information: H Limited sold goods to S Limited of rupees 120 lakhs at cost plus 20%. Yeah. So we can see there is an intercompany transaction of sale by H to S. Can you tell me quickly whether this transaction between H and S is downstream or upstream? Quickly, I'll wait for a response. Moving further, I'm waiting for a response. Inventory of S Limited includes such goods valuing 24 lakhs. Means out of these purchases which are made by S Limited, inventory worth of rupees 24 lakhs is still lying with the group. So I think over here some adjustment will be required. Administrative expenses of the subsidiary include 5 lakhs paid to H Limited as a consultancy fee. Yes. Okay, so in the meantime, I received responses from Namita, Sanjay, and Sakshi, they are saying it is downstream. Very good. Why? Because this is going from holding to subsidiary. Okay. Now there's another transaction between the holding and the subsidiary company, wherein subsidiary has paid administrative expenses worth of rupees 5 lakh to holding as a consultancy. Selling and distribution expenses of H Limited include rupees 10 lakhs paid to S Limited as commission. Means H Limited has also paid some amount to S Limited. So there seem to be many intercompany transactions over here, because as we discussed, intercompany transaction is not limited to sale or purchase of goods. It could be about anything, and which you can see over here. Yeah. Okay. Then it further says H Limited holds 80% equity share capital of 1,000 lakhs in S Limited prior to X1, X2. So this information which is available to us is for X2, X3, and we are told that the holding of 80% of H and S is something which is prior to X1, X2. So it's not a new acquisition. And H Limited took credit to its P&L proportionate amount of dividend declared and paid by S Limited for the year X1, X2. Okay. So some information about the dividend and its adjustment by the holding company is given. We need to check whether this adjustment is appropriate or not. So before I move further on to preparation of consolidated P&L, can you quickly tell me whether this adjustment made by H in respect of dividend declared and paid by S Limited was correct or not? Yeah, because I think we have already talked about this concept. You would have also covered this earlier under investments. Now it's sort of again repetition. So can you tell me whether this adjustment by H Limited in H Limited in respect of dividend is correct or not? Okay. Yes, I'm waiting for the response. Okay, so I can see this response from Shameen. Shameen is saying this is incorrect. What about others? Quickly. Shameen is saying this is incorrect. What about others? Yes. Whether this adjustment by H in S is correct or not. Sanjay is saying this is pre-acquisition dividend. This needs to be reduced from the purchase consideration. Okay, so now while preparing P&L, we may also be required to make this adjustment. So we'll address it over there. So I'll start with the consolidated statement of P&L. And as we have discussed that whenever it comes to the preparation of the financial statements or any component of the financial statement, it has to be as per Schedule 3 always. Okay. Even though the information which is given in the question is not as per Schedule 3, you will always go by Schedule 3 format. Yeah. So in this case, first of all, we can prepare the structure of this P&L, and then we can have various notes to accounts, because all the notes to accounts will have to come in. So I'll pick up the consolidated statement of P&L, and we are preparing this for the year ended 31st March. So I just write 31st March. Okay. Now over here, we will start with the revenue. So first is we have the particulars first of all. Amount. And we can get the note reference. Revenue from operations. Now, if you look at the information which is given in the question, there is nothing in terms of any other component which goes to the total income. So our total income will get closed over here. Yeah, because everything seems to be related to revenue. So we can give this note number as 1. Please remember that in case you are required to prepare balance sheet as well as P&L, then this note number will not be 1. Why? Because then you will start with the balance sheet. Then the balance sheet components will come in first of all, wherein you will start with 1, 2, 3, 4, and so on. And over here you will continue with the note number. Okay. Then we have expenses. In terms of expenses, we can say cost of material purchased or consumed. Number 2, changes of inventories of finished goods. Number 3, employee benefit expense. This is also there in the information, so we'll have to capture it. Number 4. Then we have finance cost. Then the question also talks about depreciation. Depreciation. 6. Then we have other expenses. Number 7. And then we have total expenses. So this will be the total expense. This will be the total. And we can give this as some reference so that we get the profit before tax, A minus B. So we can say this is A and this is B. Okay, so this becomes A minus B. I can see further responses from Nakul and Anantraman on the dividend adjustment. So Anantraman is saying it is correct, Nakul is saying this is incorrect because this is pre-acquisition. It needs to be adjusted for. Anyways, we'll see as to what all adjustments are required to be captured. Okay, now let's begin with this. So we'll move on to the note number 1. Note 1. The revenue from operations. Revenue from operations. So now first of all we'll capture the information about two entities. So we have sales and other income for H and S, 5,000 and 1,000. All the numbers are rupees in lakhs. Correct? Sales and other income. H limited, X limited. This is 5,000, this is 1,000. Okay. So we get 6,000 as the total sales and other income of the group. Now, please remember there is an adjustment over here. What is that adjustment? What is that adjustment? Adjustment is in respect of sales and purchases between H and S. H sold goods to S amounting to rupees 120 lakhs. Yeah. So that means this turnover, this sales include sales worth of 120 within the group. That needs to be eliminated. Less intercompany sales. So 120 we will eliminate. Okay. Number 2, because this is the information about sales as well as other income, or we can say the entire revenue. So we also understand that some consultancy fee is earned by H Limited. Correct? So there is consultancy fee of H Limited which has been paid by S Limited. So that also needs to be eliminated. Why? Because this consultancy fee is also included over here. That must be the income of H, which is an expense of S. So that income will also be reduced. Correct? So we'll reduce the consultancy fees of rupees 5 lakh. Consultancy fee earned by H from S. 5 will also be reduced. Then we understand S Limited has earned commission income from H. So that also needs to go. Commission earned by S from H. Then this will also be eliminated. Yeah. Why are these getting eliminated? Because these are all intercompany transactions. So these need to be eliminated. So we get 5865 as the total amount. We don't have any further adjustment in terms of revenue. Yeah. So the revenue is all set and we can move this number over here. 5865. And because there is no other component, so that's why this will also be the total revenue of the group. Please understand that this is the total revenue of the group. If you look at the individual components of H and S, and if you just add them, it becomes 6,000. But if you look at it from the perspective of the group, this gets reduced to 5,865. Why? Because now we are considering both these companies as single economic entities. Okay. Moving further, on to the next component, cost of material purchased or consumed. Yeah. So note number 2. Cost of material purchase consumed. Here again, we'll start with the information of these two companies, H and S. So raw material consumed given in the question is 800 and 200. So for H limited and S limited, it is 800 and 200. Okay. Now because this contain purchases, yeah. So from the sales, we have reduced the purchases. From the sales, we have reduced the sales amount which was within the group. That also needs to go out from the purchase amount. Yep. Less intercompany purchases 120. So this will be eliminated from here also. Correct? Okay. Then the production expenses are also given. That will also come under costs only. So direct expenses, which is in relation to production. Information given in the question says it's 200 and 100, and we don't see any adjustment over there. For H and S, it's 200 and 100. Yeah. So if you look at these two numbers, what do we get? This becomes 880 and this becomes 300. So we have 1180. Yeah. So this 1180 will go to the P&L. So we can close this adjustment also. This is 11. And so our second component in the P&L is also closed. Fine. Note number 3, change in stock. Changes in inventory of finished goods. So for these two companies, for H and S, we have this information available in the question. For H and S, it is 1,000 and 200. Okay. Yeah. Now, there is an information available in the question which says that some stock is lying with the group and this stock contains unrealized profit in respect of intercompany sale and purchase. So there is an unrealized profit on this inventory. That will also go out because this inventory, okay, the inventory, how do we get this change in stock? Closing stock minus opening stock, correct? So that change in stock is currently loaded with the unrealized profit in respect of those sales or purchases which are made within the group. So we also need to eliminate that part. Yeah. Okay. So how do we eliminate? Very simply, we'll just remove the amount of unrealized profit. Less unrealized profit. So what is the amount of unrealized profit? Goods worth of 24 lakhs. So inventory worth of 24 lakhs is outstanding, on which unrealized profit exists. And if you look at the information, it says goods were sold at cost plus 20%. Means this is the total amount which includes a markup of 20%. So we'll just divide this by 120. Why are we dividing this by 120? Because this is an amount which is loaded with 20%. So if you look at 100, this amount is 100 plus 20. And what is the component that we need? We need only the unrealized profit with this. We only need the markup with this. So we'll multiply this with 20. Okay. Or you can compute it either way. So what do you get? You get 4. So this gives us 4. 4 is the amount of markup. 4 is the amount of markup, or you can say the profit element in the inventory worth of rupees 24 lakhs. So we are removing this profit element. So what do we get? 1196. So this 1196 will go to the change in stock. Okay, this will go to change in stock. Yeah, this will go to change in stock. Note number 4. I think Shamim computed this amount very good. Manish is saying 20 lakhs is the cost. Yes. So 20 lakhs is the cost. If you look at the inventory at cost, this will be 20 lakhs. That's absolutely correct. Okay. Now moving on to the note number 4. Employee benefits expenses. Now for H and S, let's see what is the amount. For H and S, the amount is 800 and 150. 800 and 150. So this is 950. And we don't see any adjustment over here. It's simple. Okay. So we can just close this. Then we can go to next note number 5. This is finance cost. H and S. For finance cost, H and S. This is 150, and here again there is no adjustment. This is 150. 150. Here again there is no adjustment. Okay. 150. Yeah. Then moving further on to the next note, depreciation. On depreciation also there is no adjustment. H and S. On depreciation we have 150. Here again this no adjustment. So this becomes 150. All right. Yeah. Now moving on to next note, other expenses. Now in other expenses, we have administrative expenses, selling and distribution expenses. Okay, both of them will go to other expenses. So I can just clear this part. Yeah. Note number 7. Other expense. So in terms of other expenses, we can start with administrative expenses. Administrative expense. 200 and 100 for H and S. 200 and 100. Yeah. From this, we need to make one intercompany adjustment. Administrative expenses of S Limited were incurred in respect of intercompany transaction. So this has to go out. We have already reduced this from income component, but from the expense component, this is not yet reduced. Yeah. So we'll reduce consultancy. Okay, this was 5. So this has been adjusted, so this becomes 295. Then we have selling and distribution expenses. Then we have selling and distribution expenses. Here again, for H and S, this is 250. And for selling and administrative expenses, if you see, there is again an intercompany transaction in respect of commission, which we have already adjusted in the income part, but not yet adjusted in the expense part. So we can say less intercompany commission. Commission which is between the group companies. Then, so this is 240. Yeah. All in all, what do we get? 535. So if all of you are following this on the study material, I think there's one page numbering issue which you can ignore. So you can just move on to 10.54 please. Huh? Oh, no, there's no issue. 535 is the total amount that we get. Okay. Now, our complete P&L is done. All the adjustments have been passed. So we can just close the statement of P&L. So we get 1769 as the total amount of expense. And profit before tax, we can just compute this, 4096. This is the profit before tax. Okay. So this has also been done now. Correct? Clear on this? Now there is one adjustment which has been specified in the question. And if you look at the question, we have not made any adjustment for that. Yes or no? If you see, we have not made any adjustment for the same. Yeah. I can see Anushka has computed this. So Anushka has got the same profit amount. Very good. Anantraman has also solved this. Okay, great. So I think Anantraman has also solved this. Anantraman has solved this. Oh, so he's saying that this is negative. Sure. This is negative. That's correct. Absolutely. Shameen has also solved this. Very good. Okay, great. So now let's move on to the adjustment which is specified in the question. This is in respect of dividend. Yeah. So let's talk about it. Because many of you answered this, but still I'm waiting for responses. What do you think? This adjustment is correct or incorrect? Because now we need to address this adjustment. Okay. You must be thinking that this adjustment has not impacted the P&L. Adjustment has not impacted the P&L. So that's why what do you find? That this solution is completed? No. Why? Because the question requires you to talk about dividend adjustment also, on which you need to comment. Okay, so let's talk about it now. I think Sushil has some queries. Sushil, I'm not very clear on this. If you can specify what's your query. Okay, so the question says H Limited held 80% shares of S prior to X1, X2. So let's put down this information over here. So we have X1, X2. This is the period prior to X1, X2. And then we have this information for X2, X3, for which we have prepared the P&L. Yeah. Now, H Limited held the shares of S during this period, means prior to X1, X2. Then it says S Limited declared and paid dividend for X1, X2. For this period, dividend was declared and paid. For X1, X2, dividend was declared and paid. Now, this period is what? Post-acquisition. Correct? This period is what? Post-acquisition. Okay. This is post-acquisition period. Starting from this period. Because again, for this period, we don't know the date as to when H is holding the shares of S. But in any case, what do you understand? That the dividend has been paid for the post-acquisition period, and the dividends are paid out of the profits of the year only. Until otherwise it is specified, you will always assume dividends are paid out of profits. So in this case, dividend was paid out of post-acquisition profits, which is clearly visible. Dividend was paid out of post-acquisition profits. Correct? If the dividend is paid out of post-acquisition profits, where do you take that dividend income? In terms of holding company, I'm saying. Where will the holding company take that income? The statement of P&L. And let's understand, what did H Limited do? H Limited took credit to its P&L proportionate amount of dividend. So this is absolutely correct. This is something which was also required to be done. Yes or no? So this was required to be done and this has been correctly done. So is there any problem in this? No. So this is perfectly all right. So that's why, do we need to consider this? No. We understand this is correct. So that's why this will nowhere impact the financial statements. Manish is also saying it is correctly adjusted because the date of acquisition is not given. See, even if the date of acquisition is given, let's suppose that is, you can say 1st of February 2000 X1. Let's suppose this is 1st of February 2000 X1. Or let's suppose this is, say, 30th March 2000 X1. Let's suppose these two dates are given. Still, can we say that our answer will change? Tell me. Because Manish has raised this point, so that's why I'm asking you. Even if these two dates are given, or either of these two dates are given, do you think the dividend adjustment of taking it to P&L will change? Tell me. Yes or no? Shamim is saying, sir, here all the adjustments were given effective twice. One thing is clear, how to identify some clarification on these adjustments. I'll come to your question. Okay, so she is fine with this now. Okay, Manish is saying, no, sir, even if the dates are given, this will not change. Understood now? Yeah. So it's not that because the question is not giving the dates, that's why you're saying it will go to P&L. Even if the date is given in the question, still it will go to P&L. Clear? Anant Raman is saying it is post-acquisition only, and that's why this will not be impacted by the dates. That's absolutely correct. Okay. Now moving on to the query of Shamim. He's saying, how do we identify intercovenant transactions? It's very simple. If you go back to this question, in this question, 3 adjustments have been given, or you can say 3 transactions have been specified. And the question is clearly telling you that these transactions are between the group companies. So there is no further analysis which is required to be done. Question is directly speaking about this. What you can do is you can always mark it. Whenever you are solving it, please make sure that 3 adjustments are recorded. And whenever any adjustment will be recorded, double entry system has to be followed. So if you are making the 3 adjustment on one side, that should also be gone to the, that should also be taken to the second side. Yeah, correct? Yeah. So that is how you need to deal with this. Okay. Clear on this? Clear on this now? Yeah, clear on this? The solution doesn't change because of this, huh? That is something you need to remember. Sakshi is clear on this. All right. So now moving on to the next adjustment. Okay, so now moving further on to this principle. Whenever two companies are consolidated, so we have H and S. The concept that we follow is line by line entry. Whether it is our balance sheet or P&L, line by line entry means all the components of H and S are added together, wherein certain adjustments are made. Okay, and that is logical because those are intercompany, so we are looking at this. And let's see this. Now, whenever two items are added together, it is very, very important that those items are similar in nature. Similar means, if let's suppose this is PPE, so PPE is some amount, you will add that to PPE only. Of course, yeah. If let's suppose this is inventory, so you'll add inventory amount to inventory. If let's suppose this is revenue, you will add revenue to revenue. Correct. Now, in these three examples that I have picked up, okay, and these could be about any three items or any of the components. What further becomes important is that the way these amounts are recorded by both the companies is similar. The way these amounts are recorded by the companies is similar. Why? Because only then it will make the user understand about the total picture of the group. Let's understand. Say, if one of the group company is recording inventory, say on the basis of FIFO. Okay, so I'll just pick up inventory only. Say H is recording inventory using FIFO. FIFO is the method of computation. Okay, and let's suppose S uses weighted average. So H uses FIFO and S uses weighted average. Now, let's try to understand the implications. Say, for example, inventory of H is rupees 100 and inventory of S is rupees 50. Okay. Now, will the amount of inventory remain same if H would have followed weighted average? Answer is no. If H would have followed weighted average, let's suppose this amount would have been 1. Okay. Now, let's suppose if the two companies are following different accounting policies, means different ways of recording these two items. Different ways of recording these two items. In such a scenario, what will happen? We will add these. What do? We will add these. So inventory of the group will become 150. 100 plus 50. This will become 150. And if the user will read the financial statements of the group, what will he understand? That the inventory of the group is worth rupees 150. But is this the correct information? No. Why? Because at one place he will read the accounting policy of the group. And the accounting policy has to be one. It cannot be two. As we all understand, group will have one accounting policy. Company will have one accounting policy. So if you are considering group as single economic entity, so that group should also have one accounting policy. Now, if the user thinks this is FIFO, then is this total correct? No, because on the basis of FIFO, this amount may change. If the user thinks this is weighted average, then is this total correct? No. So that's why what is important, that the way these two components are recorded is same, is kept same. Okay, yeah. Or in other words, we can say that the accounting policies of the group companies should be uniform. Those should be similar. There should not be any difference in terms of the accounting policies of the group. Those should be similar. The group should be following similar accounting policies always. Only then the consolidated financial statements which will be prepared will give us the right information, will give us the exact picture of the group. Understood? Yeah. Clear on this? Yeah. Okay. So now accounting standard says that whenever you prepare the consolidated financial statements, make sure that the uniform accounting policies are followed by both the group companies or all the group companies. If at all standalone financial statements contain different accounting policies, let's suppose that this is the situation wherein one company follows FIFO, other one follows weighted average, then for the purposes of consolidation, those should be made uniform. Yeah. Unless it is impracticable to do so. And here again, the reasons of not doing so should be given in the financial statements. Yeah. Unless it is impracticable, this should be done. Alright? Clear? Okay, so now what we will do is we will pick up one illustration. Illustration number 13, wherein some of these principles will pick up for the purposes of alignment. Yeah, okay. Using this, we'll prepare the consolidated balance sheet. So let's move on to illustration number 13 now. Subsidiary B Limited provides the following balance sheet. So we have the balance sheet available for subsidiary. 2 years information of subsidiary is given. Please remember, this is the information for one subsidiary. This is not the information for holding and subsidiary. Okay, please be careful. We are given the balance sheet of the subsidiary for 2 years. Alright. Then I think we also have the notes. We have the notes. So if you will see, the further information is about various notes to accounts. Okay, great. Then the additional information is given. It says, also consider the following information. B Limited is a subsidiary of A Limited. Okay. Both the companies follow calendar year as the accounting year. which is fine. So instead of financial year, we need to use the calendar year. That is absolutely okay. A Limited. Who is A Limited? Holding company. A Limited is holding company. And B Limited is subsidiary. Yeah. A Limited values inventory on weighted average basis. So for inventory, A Limited uses weighted average. B Limited uses 3-4. No problem. So we have to make some adjustment at the time of consolidation for the alignment of the accounting policy. This seems to be different right now. To bring the values of B Limited in line with those of A Limited. Obviously, B has to align with A. Yeah. Its value of inventory is required to be reduced by 12,000 at the end of X0 and 34,000 at the end of X1. Great. So now the question has only specified that for alignment of accounting policy, what adjustments need to be done. Yeah. So the question is itself telling you that make this adjustment for the alignment of accounting policy. We'll do this. Next, B Limited deducts 1% from trade receivable as a general provision against doubtful debts. For doubtful debts, B Limited deducts 1% of trade receivables. This is what B Limited does. It deducts 1% of trade receivables. Okay. Then prepaid expenses in B Limited for the PC. There is some information about prepaid expense. Prepaid expense in B Limited include advertisement expenditure carried forward of rupees 60,000 in X0, which was then carried forward at 30,000 in X1, being part of initial advertisement expenditure of rupees 90,000 in 2000 X0, which is being written off over 3 years. So we understand that there was an advertisement expenditure, and this is written off over 3 years by the instead of charging it off, which is the ideal treatment for this. This is being written off over 3 years. Similar amount of advertisement expenditure of A Limited has been fully written off. So A Limited charges it in the year of incurrence. This seems to be the correct accounting policy. No problems. We'll have to make all of these adjustments. And we also need to check whether this provision which B Limited is making of 1% of trade receivables is correct or not. Okay, this also needs to be analyzed. So basically, this question is not only testing about the understanding of alignment of policies. This question is also testing your knowledge about some basic concepts of accounting. Means whether this adjustment is correct or not, whether this adjustment is correct or not. Yeah, clear? Okay. Then the question further says, restate the balance sheet of B Limited as at 31st December X1 after considering the above information, it requires you to restate the balance sheet of B Limited as at 31st December next year. For the purposes of consolidation. Now, please remember one point, that whenever it comes to the financial statements, two types of situations are possible. One, when the standalone financial statements are required to be corrected. Over here, we don't need to get into standalone financial statements. Why? Because these two companies are different. If you look at A and B, they are different companies. Even if they happen to be group companies, even if they happen to be in a relationship of holding and subsidiary, still these two are two different independent legal entities. And that's why for their standalone financial statements, they can always have their independent accounting policies. Independent means which is not aligned with each other, which is absolutely okay. There is absolutely no problem in this. But if they continue to follow different accounting policies for the purposes of consolidation, alignment is important. So that's why B Limited will have to align its accounting policies when it goes for consolidation. Okay. When it goes for consolidation, B Limited will have to align its accounting policies. Clear? Clear on this? Yeah. Now, moving further, we will now start with the alignment of accounting policies of both. It further says, would the restatement be necessary to make the accounting policies adopted by B Limited and A Limited uniform? We'll have to understand. Okay, yeah. So now we can move on to the balance sheet of B Limited. If you look at the information, if you look at the requirement of the question, you are required to prepare balance sheet as at 2000 X1. Even if the question gives you the information for 2 years, you are not required to prepare the balance sheet for 2 years. Only for 1 year it is required. Okay, clear on this? Yes, we don't need to get into 2 years. That's a good thing over here. But still, even if 2 years are not required, still you may have to add some information from the previous years. So let's move on to the balance sheet of B Limited. And because the balance sheet has to be prepared, so that's why it has to be in the format of Schedule 3 only. It cannot be any other format. So we'll go by the format of Schedule 3 over. Now, balance sheet of B Limited is already prepared, but there are certain adjustments which are required, which are in the nature of corrections also. If you look at this advertisement, that is a correction only. If you look at the alignment of accounting policy for the purposes of consolidation, this has to be corrected for not only the current year but last year also. And then we have to see as to what will the impact of the same. Okay, that's why we will call this balance sheet as restated balance sheet. So we'll say restated balance sheet of B Limited. I said 1st March 31st December as at 31st December 2000x1. And then we will bring in all the components of the balance sheet on the basis of the information which is given in the question. Correct? So we have equity and liabilities. Around the loan. Shareholders' funds, share capital, reserve and surplus. Shareholders' funds, share capital, reserve and surplus. This is one, this is two. Short-term borrowings. This is again available in the question. Trade payables, short-term provisions. So we have current liabilities. We don't have any non-current liabilities. Short-term borrowings. Then we have trade payable, and then we have short-term provisions. 3 and 4. For trade payable, we are not using any note because this is a direct information, no adjustment is required. But if you want, you can always create a note. There's absolutely no problem if you create a note. Okay. Next is on the assets side. Non-current assets. PPE. After PPE, we also have non-current investment. Because we are giving a note for PPE, but non-current investment again is sort of direct. That's why we are not using any separate note for this. Okay. Then we have current assets. Inventories, trade receivables, inventory, trade receivables, cash and cash equivalent, other current assets. All right, so we can give the note 6, 7. For cash and cash equivalent, again the information is direct, so that's why we are not using any note. We are just moving directly to note number 8 for other current assets. Yeah, clear on this? Okay, and now we'll start putting the notes for each and every. Moving on to note number 1. Share capital. We'll have to write down the information clearly the way it is given in the question. So the information given in the question says 5,000 equity shares of ₹10 each fully paid up. 5,000 equity shares of ₹10 each. Fully paid up. 5 lakhs. And I think these are not ₹10 each, this should be ₹100 each. This should be ₹100 each. So you can make this correction, please. This should be ₹100 each. Only then this will become 5 lakhs. So I can take this to the balance sheet. Okay, so our first component is completed. Our first line item, share capital, is completed with this. Okay. Yeah. I'll go to note number 2 slightly later. Why? Because certain adjustments which are going to come in respect of trade receivables, means the writing of our trade receivables, in respect of change in inventory. Yeah, change in inventory in terms of its valuation, and in respect of this adjustment expenditure, all of them will hit the reserves. They will definitely have some P&L impact. Yeah, they will definitely have some P&L impact. So that's why its impact will go to the balance sheet, because we don't have the P&L over here. We only have the balance sheet. So that's why it will have an impact on the reserves. So I'm just skipping that for the time being. Note number 2. Okay, so this was note number 1. I'll go to this note number 2 slightly later. For the time being, you should leave some space for note number 2. So I'm jumping on to note number 3 now. Yeah. Note number 3 is for short-term borrowings. This is again kind of direct, but still we can put this information. Note number 3, short-term borrowings. And in case of short-term borrowings, what do we have? We need to use the information which is given in the notes to accounts in the question. It includes bank overdraft of rupees 1,70,000. Bank overdraft 1,70,000. There is no adjustment on the bank overdraft. So that's why we can also move this amount to balance sheet. Next, note number 4. But before note number 4, let's see the trade payables. So trade payables are direct 4,94,000. 4,94,000. Here again we don't have any else. Note number 4, short-term provisions. In case of short-term provisions, what do we have? Provision for taxation. And what is the amount? 4,30,000. Again, there is no adjustment on this. $4,30,000. There is no adjustment in this case. Next is about PPE. Okay. Note number 5. Property, plant and equipment. Property, plant and equipment. PPE. Now for this, again, we'll need the information in the question. Cost 3,30,000 less depreciation 96,000. Less depreciation. What's the amount? 96,000. So what do we get? We get 2,24,000. $2,24,000. Then the next one was non-current investments. I think this was again direct. 4 lakh was the amount, and there is no adjustment in this. So we can plot this information also. 4 lakh. Okay, yeah. All right, so then moving further on to note number 6. Note number 6. Now I think all of those adjustments will come in. Yeah. So that's why what we can do is we can move on to a working note, because all of those adjustments will come in. So we can move on to a working note first of all before picking up the notes further. Otherwise, we'll have to just keep skipping the notes. Now, in this working note, what do? We will make the adjustments for policy change and any corrections if required. Yeah. Now I need your attention, please. Because some of these adjustments may be confusing. So that's why I need your attention. We understand that only the balance sheet is required to be prepared. Okay. Had it been a case wherein the P&L was required to be prepared, then some of these adjustments would have impacted the profit and loss, and we would have considered those adjustments in terms of its impact in the balance sheet as well as the P&L. But in this case, P&L is not required to be prepared. But anything which hits the P&L will impact the reserves. We know this. So that's why, what do we need to do? That's why we need to pick up the amount of reserve and put the impact on all of those reserves one by one. Yeah, so we'll take the impact to all of those reserves one by one. So that will be our approach to deal with this. Okay, so we'll start with the balances of reserves. The balance of reserve, which is given as at 31st March X1, is 7,14,000. Balance of reserves as at, sorry, this is not 31st March, 31st December. This is 7,14,000. Okay, now. First correction is about the advertisement expenditure. Advertisement expenditure, if you see, that is still being carried. That is still being carried. Why? Because this was deferred. So 30,000 is the amount which is not yet charged off. So the part which is already charged off is done. But the part which remains needs to be immediately charged. Advertisement expenditure to be charged. So 30,000 will charge. So this will reduce the amount of reserves. Yeah. Next, provision for doubtful debts. Now, there is a strange adjustment of provision of doubtful debts, which B Limited seems to be doing. Let's understand what the adjustment. 1% of trade receivables. So what is the amount of trade receivable? Trade receivables are 8,91,000. 8,91,000 is the amount of trade receivables. Yeah. This amount is after making a provision of 1%. Provision of 1% has been made on this amount. So this means this is what percent? This is what amount? This is 99%. And if we have to get the total amount, what do we do? We multiply this one. This will give us the total figure without considering the provision. Correct? Yeah, I'm repeating. So we are saying that the company is making provision of 1%. I'm just trying to compute that amount. Currently, that amount is reduced from the debtors. So this amount is reduced to balance. Means, what is this amount? This is 99% instead of 100%. So I'm dividing this by 99 and multiplying this with 100. So this will give me the total amount. Total amount becomes 9 lakhs. So if you compute it, it becomes 9 lakh. And 1% of 9 lakh will be 9,000. And if you reduce 9,000, you get 8,900. Okay. So we'll say minus 8,91,000. Yeah. So what do we get? 9,000. Now, the question arises that this 9,000 has been charged off to the P&L. The basis for creating a provision of doubtful debts has to be the one wherein the debts become doubtful. See, the moment debt becomes doubtful, provision should be created. We agree with that. But if the company picks up some ad hoc basis, company says on all the trade receivables, I'll charge 1%. Is that the correct accounting treatment? Is that the correct way of recording a provision? No. That is not acceptable. That is not correct. So that's why what should the company do? Company should add it back. So company has already recorded an expense of 9,000. So the reserves are reduced by 9,000. So what are we doing? We are adding back this amount to the reserves. Clear on this? Clear on this? Yeah. If you have any doubts, any questions on this, please let me know. So we are adding back this amount to the reserves. Okay. Because of which, what will happen? Reserves will increase. And in a way, we are saying we are doing away with this type of provisioning mechanism. This is not correct. Because the question doesn't say whether the holding company is following this or not. We just simply understand this is incorrect, so that's why we are making this correction. Yeah. Next adjustment is in respect of inventory. Now the opening inventory is required to be reduced by 12,000 and the closing inventory is required to be reduced by 34,000 to align the accounting policy. So adjustment of inventory 34,000 needs to be reduced. 34,000 needs to be reduced. if you go back to the last year, question says inventory of 31st December X0 also needs to be reduced by 12,000. Yeah. So let's suppose if we go back to the last year and we reduce the closing inventory of last year by 12,000, and we also take the same balance in the opening balance. So what will happen? Its impact will go away. Its impact will go away. Yeah, clear on this? So that's why we are not making any adjustment for the sale. So this we will get the revised amount of reserves. 6,59,000. So after making all of those adjustments, after making all of these corrections, what do we get? We get 6,59,000. Clear on this? Yeah, all of you? Namrata has a query. Namrata is saying, please repeat doubtful debts form. Sure. So let's come back to this. If you go back to the information, question says B Limited subsidiary deducts 1% from trade receivables as a general provision against doubtful debts. Is there any concept of general provision as per the accounting standards? No. Accounting standards don't require any creation of general provisions. That has to be specific, that has to be created when the debt is doubtful. But just to say that all the trade receivables to the extent of 1% are doubtful and to take it to P&L is incorrect. So what are we doing? We are just reversing the impact which was taken by B Limited to P&L by adding it back to the results. Now, how do we compute it? We are given 8,91,000 as the closing balance of trade receivables. We understand that this is after reducing 1%. So what are we doing? We are first of all computing the gross amount of trade receivables using this formula. And from gross amount, we are reducing the net amount. So what do we get? 9,000. Now clear on this? Namrata, you are now clear on this? Please confirm quickly. All of you, you are clear on these adjustments? All of you, you are clear on these adjustments? Okay, Shamim is saying, sir, one more adjustment, that is on inventory. See, inventory adjustment is direct. Read the information of the question. Question says, A Limited values inventory on basis different from B. Whatever is the basis, policies are different. Now, what is the objective? To align the accounting policy of B with A. Then the question says, to bring the values of B in line with A, value of inventory of B needs to be reduced by 34,000 at the end of X1. So we have reduced this. So if you reduce the value of inventory at the end of X1, there will be an alignment. Okay. Number 2, it says also reduce the value of inventory of X0. But when is that required to be done? When we prepare the balance sheet of X0. Are we preparing the balance sheet of X0? No. We are only preparing the balance sheet of X1. So that's why we have adjusted this. Clear? Now clear on this? Shamim, you are clear on this now? Please confirm quickly. You are clear on this? The Mamta seems to be clear on this. What about others? Any more questions? Any more doubts on this? Yes, quickly on. Any questions, any doubts in case you have on this? No? Alright, so what we can do is we can We are still left with one small part of this, wherein some remaining notes have to be prepared, but I think we are just towards the closure of this, and I would suggest you can just complete the remaining part of the solution on your own. Okay, I'll also come to the solution, but we are now taking a break because I think I've already stretched this session a bit. So that's why let's take a break. In the break, if you want, you can also complete the remaining part of the solution. Otherwise, we'll continue with the remaining part after the break. Okay, yeah. So let's take a break. Now continue with our discussion. So we're left with few notes. So let's wrap up these notes. So we'll continue with note number 6 now. And this working note will be required in all of those notes to account, because all of these adjustments will be picked up in those notes as well. So moving on to note number 6. This is on inventory. And for inventory, we have a closing balance of 7,42,000. Inventory. Yeah. Closing balance 7,42,000. Okay. Now in this, we need to make the adjustment. Why? For alignment of accounting policy. Less change in the method of valuation. $54,000 is the amount which needs to be reduced from the value of inventory. So this becomes 7,08,000. So Sanjay has a query. Sanjay is asking, why did we not reduce the opening balance of the inventory? Because the question only requires us to prepare the balance sheet as at 31st December 2000X1. And please understand that if you reduce the balance of opening inventory, you would have also reduced that balance in the closing inventory of last year. So would it have any impact on the reserves? No. Understood? Moving on to the next note, note number 7. This is for trade receivables. Note number 7, trade receivables. So closing balance 8,91,000. And we need to make the correction. Add provision adjusted earlier 9,000. So 9,000 we need to adjust. So this becomes 9 lakh. Okay. 7,08,000 will take over here. 9 lakh will take here. Cash and cash equivalent. This is a direct number. No note is required. So this is 3,000. This is 3,000. Next, note number 8, prepaid expenses. So note number 8 is other current assets. So we give the head as other current assets. and this includes only prepaid expenses, 48,000. Which will continue. Yeah. $48,000 will continue. Okay, so then I think we are still left with one more note. That goes on reserves. Note number 2. Reserves and surplus. Reserves and surplus. Now, what is the line item? It is general reserves in the notes to accounts which have been shown. So we'll also say general reserves. And we don't need to give the further information because we have already prepared a working note for this. We can give the working note reference. Okay. As per the working note, this amount should be 6,59,000. We'll take this over here. Now you can start taking the total of these. And you can now tell me whether the two sides of the balance sheet match or not. Okay, whether the assets are matching with liabilities or not. Quickly. Give me the totals, please. Quickly. I'm waiting for a response. Whether they are matching or not. Okay. So waiting for a response. Sanjay seems to be clear on this. Okay, what about others? Quickly. Sure, you would have solved this. What's the total? Assets and liabilities are now matching. Yeah, they are matching now. Great. So Sanjay has completed this. He is saying yes. These are matching 22,53,000. And this is not the total of assets. Please don't get confused. Okay. Same is the answer over here. 22 lakh. 50. Yeah. Both the sides are now matching. Okay, so now we'll move further and we'll discuss one more consolidation principle. For the purposes of consolidation, we'll discuss one more principle. Let's understand that. We discussed about alignment of accounting policies. Why? Because this was important. Because if the nature of items are not recorded on the same basis, then the correct information, correct understanding about the group financial statements will not be drawn by the users of the financial statements. Similar to this is another principle, and that is about reporting dates. Let's understand this. What is this principle? What does it require? How do we need to deal with this? Here again, let's start with two companies, H Limited and S Limited. See, this problem will arise whenever we have any group company, or you can say whenever we have any adjustment in relation to a foreign subsidiary. In case of a local subsidiary, this adjustment will not arise. Let's understand why. Say, if the holding company follows accounting year, which is from 1st of April to 31st of March. This is the accounting year which the holding company follows. But the subsidiary is a company, let's suppose, which is based out of US. Okay. And that's why it uses calendar year as its accounting year. From 1st of January to 31st of December. This is the year which is followed by subsidiary for the purposes of its financial statements. So we are talking about standalone financial statements. Means when the subsidiary prepares its financial statements, it is from 1st of January to 31st of December. Now, let's try to consolidate these. So now what will happen? Say if we pick up 31st March 2021. On 31st March 2021, holding company will require information of subsidiary for consolidation. Okay. And whenever the information will be consolidated, that should be for the same period. Subsidiary cannot give the information from 1st January to 31st of December, even though these are 12 months. But will it be right to capture these 12 months with these 12 months? No. That will be incorrect. Period has to be same. So that means subsidiary should also produce the information from 1st of April to 31st of March 2021. But the subsidiary doesn't have that financial statement. Why? Because it will close its financial statements for these 3 months in the next year. And for this calendar year, financial statements are already finalized and closed. Yeah. Now, this problem will not arise in case of a local subsidiary. Why? Because in India, all the companies will be following the financial year. But in case of foreign subsidiary, this problem will arise. Okay. So now, how do we deal with this problem? Standard says, whenever CFS will be prepared, so for the purposes of CFS, reporting dates, or you can say accounting years of all the group companies should be same. Those should be same. Financial years should be same for all the group companies. Means subsidiary should also prepare its financial statements from 1st April to 31st of March. This is the first requirement of the standard. And if this is done, then I think it's absolutely the same thing which we have discussed so far about the consolidation. But we see a practical problem in this. Because this is a company which is based out of US, so that's why this company will not be preparing its financial statements from 1st April to 31st of March. And even if it prepares from 1st to 31st of December 2020, and if the holding company requires this company to prepare its financial statement from 1st of April to 31st of March, may become practically difficult for this company to prepare its financial statements for 2 periods. Though some companies already do this, but it may become difficult for them. Yeah. So the first option is to prepare for the purposes of consolidation. Means S will prepare one more set of financial statement from 1st April to 31st of March and submit that for consolidation over here. So this is the first option. Or you can say this is the preference. This is the requirement of the standard. This is also called as alignment of reporting dates. Alignment of reporting dates. Okay. This is also called as alignment of reporting dates. But let's suppose due to any reason subsidiary doesn't produce financial statements from 1st April to 31st of March. In this case, standard says that even if the reporting dates of holding and subsidiary are not same, it will be all right. Standard is saying no problem, you will accept it. Yeah, this is acceptable. The only thing is that the difference in the reporting dates between the holding and the subsidiary should not be more than 6 months. The difference in the reporting dates of the group companies should not be more than 6 months. Currently, the difference is only 3 months. Currently, if you look at this difference, this is only 3 months. This difference is acceptable. This difference is acceptable. Okay. But this difference should not cross 6 months. If this crosses 6 months, then it is unacceptable. Number 1. Okay. So that means if we talk about alignment of reporting dates, one is of course the alignment. Second is difference of 6 months is acceptable. This is acceptable. First thing is to align this. If alignment is not possible, keep them separate, let them remain separate, but the difference should not exceed 6 months. But in this second scenario, standard says that if during this period, what is this period? This is the period of difference in the reporting dates. Any significant transactions have taken place. We are talking about the subsidiary because we are looking at the books of subsidiary. Let's suppose in these 3 months, some significant transactions have been recorded, though those are not appearing in the financial statements. Why? because that has been reported up to 31st December only. In such a scenario, what does the standard say? That those significant transactions should also be captured in the CFS. So what will happen? CFS will pick up three things. First, financial statements of H from 1st April to 31st of March. Number one. Number two, financial statements of S with a difference of 3 months. Okay. Number three, those significant transactions which are not reported in the financial statements of S. Okay. These three things need to be captured. So if this difference is accepted, if the financial statements are given with a difference of 6 months, it should be captured. So that's why I'm saying, along with this, any significant transactions should be captured. Okay, clear on this? Yeah. So before I move further, if you have any questions, any doubts on this, please let me know. I think Aditi has a query on illustration number 13. So let me just go back to this query. Sorry, this illustration number 13. So what's the query, Aditi? Yes, other current asset which comes to 48,000 as per the working note while writing, they used 18,000 due to which asset side total comes to be different, which is different from. Oh, let me just check this one. So can you give me the total of both of them? Because I think this seems to be. Let me just pick this from the most accounts only. Oh, so this seems to be a typing problem only. Yeah? You can just correct this. I just noticed this. This seems to be a typing problem. You can correct this. Let me just also take the total of this. Yes, you can take the total as 18,000 rupees, and this you can capture it. I think this 48,000 will be further adjusted, and this is because of the fact that this 48,000 includes advertisement expenditure which has been written on. So that's why it should be cut down to 18,000. So this is absolutely correct. You can also make this correction. I think in the notes to accounts, this is not corrected, so you can correct it. Okay. I think same is the query from Sakshi. So Sakshi, I think this is clear. Okay, Sanjay has a query. Sanjay says that in case of difference in the reporting dates over here, okay, difference will be the consolidation of subsidiary which starts from April or 1st of January, from 1st April to 31st March or 1st January to no. Let me just clarify this point. When you will pick up the financial statements of subsidiary, you will not pick up this period. Okay, you are only going to pick it up from 1st of April. That's why, what are you doing? These 3 months which have been missed out, any significant transactions for these 3 months you will pick up separately. So that any material transaction during these 3 months doesn't get missed in terms of recording the consolidated financial statements. Now clear on this? That's why I drew this line. Okay, clear? Aditya is saying, so the significant transactions that occur post finalization of financials of subsidiary, but before 31st March of holding company, is this statement correct? No. Please understand that the financial statements which you prepare are as at 31st March. But do you prepare the financial statements on 31st March of the every year? No. You take some time. So when are the financial statements prepared? During this period. Some of the companies may take 1 month, some of the companies may take 2 months, 3 months, 4 months, depending on their financial reporting process. It is not prepared on this very day, because on this very day books are closed. Financial statements are required to be prepared as of 31st March, but these get completed after 31st March. So that's why for these 3 months, let's suppose financial statements are required to be finalized by, say, 30th September 2006. Okay, let's suppose this is the date. Now, on this date, you will know if there are any significant transactions during this period. Okay. On this date, because you will know about these significant transactions, so what will you do? You will pick up this one, you will pick up this one, plus you will pick up significant transactions on this one. Now clear on this? Sanjay seems to be clear on this now. Okay. Now clear on this? Yeah, Aditya, clear on this? Aditya, I'm hoping you are also clear on this. Please confirm, then we can move further. Please quickly, you can confirm quickly, we can move further. Yeah? All of you clear on this? Yes, still left with one small concept. I'll get on to that concept now. Yeah, if your queries are all done, I can move further. All done, all clear? Okay, Manish has a query. Manish is asking, sir, if the reporting period can't be aligned for CFS purpose and the company presents CFS, then how it will be correct? Like assets value will differ? No. As I have clarified, what is the problem of the subsidiary? Problem of the subsidiary is that they don't want to prepare financial statements for same financial. Okay, they don't want to prepare the financial statements for same financial. That's why, what will they do? They will submit the financial statements for the curtailed period which they have. Because this is already available with them. With a difference of 3 months. With a difference of 3 months. So that's why no such problem will arise. Because even if the curtailed period is given, assets and liabilities will always be matching. Okay. Sanjay is saying, is there any question based on different accounting? Because this was the question only. Yeah? This is how you will align this. You don't need to get into this, I think, more than this. I think this much explanation, this much understanding will be good enough for all. Okay. Clear on this? Yeah? Okay, so now, before I move on to this next principle, we can just quickly summarize. We can just quickly summarize all those principles of consolidation. So when we start with the consolidation, what is the first thing we need to remember? Single economic entity concept. This is the concept within which consolidation will go on. And the consolidation principle which we need to follow is line by line addition. Okay. When will this start? This will start from date of acquisition. And when is this line by line addition required to be done? As on the reporting date. Or you can say date of balance sheet. On the date of balance sheet, this is required to be done. Okay. Next, on the date of acquisition, two things are required to be considered always. First, goodwill or capital reserve. Okay. Second, minority interest, if any. So it is not necessary that minority interest will always be there. Why? Because if the subsidiary is wholly owned, minority interest will not come. If you want, you can note down all of these points. I'm just trying to completely summarize each and everything related to consolidation in this. Okay, and with a flow. So I'm just trying to make an effort for this. Further, on the minority, we understood that this minority cannot become negative. This cannot become negative unless there is a binding obligation on the part of minority through a contract. So that's why, if this cannot become negative, who will take up the losses of minority if it starts becoming negative? Holding will pick up losses of minority if it starts becoming negative. Okay, yeah. Next. Now, for the purposes of line by line addition, which is required to be done as on the reporting date, there are few things which are required. First, uniform accounting policies. These are required. Uniform accounting policies are required. Number two, reporting date should be aligned. Alignment of the reporting dates. The reporting dates should be aligned. Okay. Next, for this purpose of the preparation of consolidated financial statements, this minority interest will have to be remeasured. Remeasurement of minority will be required. And goodwill or capitalism should also be remeasured. Though the questions we have discussed, they don't require any change in this. But still at times, there could be an amortization of goodwill. If there is an amortization of goodwill, goodwill will go down. Clear? Yeah? For all of these principles, in fact, particularly related to goodwill or this minority interest, etc., there's one more point which you need to remember, and which is important on the date of acquisition. That is about bifurcation of reserves, profits into pre-acquisition and post-acquisition. So we need to pick up pre-acquisition profits or reserves and post-acquisition profits or reserves. Okay, clear on this? Yeah. So if you look at all of those principles, all of these concepts, this is what we have tried to consider, or this is what we have practiced over the period. So I'm not going into details of each and every point, but these are the consolidation principles, consolidation adjustments, which you need to remember at every point of time. And in respect of all of these principles, you need to always remember one point, that when you will be doing this line by line adjustment, certain eliminations may also arise. And why will those eliminations arise? Because of this larger concept. This larger concept you need to always remember. That is about single economic entity. If you keep your thought very clear while solving the question, that the financial statements of the group of various companies which you are preparing are not really various companies. That is one entity, one economic entity. Most of your adjustments will automatically get cleared. You will be able to pass the adjustments on your own. Okay? Clear? Clear on this point? Yeah? Okay, so now I'll just move on to this last principle, very small concept that we are left with. This is about treatment of subsidiary company which is having preferential capital. Okay, so you can go to this page number 10.60, and this is section 20, means para 20. And please remember that this concept has been discussed in the material, so that's why it's important to have a understanding of this concept. We don't want to miss out on anything. Yeah. But don't get into details of these concepts. That is not required. A simple, limited understanding of this concept will be helpful for your information. Now, a subsidiary may also have preferential capital. So far, all the subsidiaries that we have discussed were the ones wherein H Limited acquired S and H Limited acquired equity shares of S. Okay, so every time when we were discussing about this, we were saying H Limited held equity shares of S. This subsidiary may also have preference shares. Now we are discussing about those preference shares. Okay. Outstanding cumulative preference shares issued by a subsidiary are considered in the same manner as any other liability, such as debentures. Accordingly, costs associated with such cumulative preference shares need to be adjusted. And now, for this one, it says, now these preference shares could be of two types: cumulative or non-cumulative. If these are cumulative preference shares, if the subsidiary has issued cumulative preference shares, so what do you need to do? You will consider these cumulative preference shares like a liability. So they will be treated like a liability. And the preference dividend on these cumulative preference shares should also be recorded as a liability. Will not say that this is not payable. That will keep getting accumulated. That's why the name is given, cumulative. Even if this is not paid, even if that is not declared, still that will accumulate. Okay, which makes these preference shares in the nature of a liability. So they will be treated like a liability. Okay. Therefore, while computing its profits or losses, means while computing the share of profits or losses of the subsidiary, the parent should make adjustments in respect of preference dividend on outstanding cumulative preference shares issued by a subsidiary and held outside the group, since for the group such preference shares represent external liabilities. It would be appropriate for the parent to compute its share of profits or losses after adjusting for the subsidiary's cumulative preference dividends, whether or not profits are available or whether or not dividends are declared. Now, what does it mean? At the time of consolidation, as we have discussed, that holding company will pick up its share of profits. Let's suppose holding company has 80% shares in S and 20% are held by minority. Okay. Now, the preference shares which the subsidiary has issued is to, say, third party. So this is H, minority interest, let's suppose is Y, and let's suppose preference shares have been issued to Z Limited. Now Z Limited is the preference shareholder outside the group. So that's why what will happen? S Limited will have to make the payment to Z Limited for the preference dividends. Even if preference dividends are not declared, it's a charge for subsidiary, which the subsidiary cannot ignore, even if this is not declared. Okay. So now at the year end, when H will pick up its profits, so what will happen? Profits, let's suppose, profits of S will be picked up. So what will H do? Let's suppose this is X. So H will pick up 80% of X. Yeah. Now in this case, the dividend which is payable on the preference shares, let's suppose that is PD, that needs to be reduced. Preference dividend. So profits of subsidiary need to be reduced by the preference dividend, and that particular amount needs to be picked up by the holding company. So holding company, while picking up its share of profits, will reduce preference dividend and then pick up its share. Clear? Clear on this? Further, it says, in case the preference shares are non-cumulative, let's suppose it is non-cumulative. The other category, preference shares are non-cumulative. In such a case, we will not consider preference dividend as a liability if that is not declared and paid. Clear on this point again? So we are saying that if the preference shares are cumulative, then definitely the preference dividend on that has to be considered irrespective of whether you declare dividend or not. But if the preference shares are non-cumulative, as the terminology only says, non-cumulative means dividend will not get accumulated if that is not declared, and dividend will be payable only if it's declared. Okay, so in this scenario, the preference dividend will not become a liability. This will not be a liability. So which means that this adjustment which is required to be done is only in which scenario? This scenario. Required only for cumulative preference. Required only for cumulative preference. This will not be required for non-cumulative preference. Okay, clear on this? Now, before we conclude our discussion, what you can quickly do is, you can just quickly go to page number 10.54. You can go to page number 10.54. Therein, a concept of consolidated cash flow statement has been discussed. And here again, we don't need to get into the preparation of consolidated cash flow statement. What you just simply need to understand is that the cash flow statement of holding and subsidiary will also be working on the same principle, means line by line addition. That's the principle you need to follow for cash flow statement. Okay, yeah, and of course, if there are any eliminations, those eliminations will also be going. Clear? Clear on this? Yeah. So with this, we come to an end to our discussion on consolidation and on our session also. Yeah, and we don't have any further discussions on consolidation because we have wrapped up this one. And I'm just hoping that you would have understood this topic. But one important point for all of you before we conclude, please make sure that you revise all of these concepts once. It is very, very important. And also practice questions based on all of these concepts. Yeah, so there are various questions given in the study material. Some of the questions we have already solved. You should also solve that once again on your own, on the basis of which you will be able to understand the concept in a better way. Yeah, clear? All right. So with this, we can just end our discussion. Thanks to all of you once again for your time and for your wonderful participation. Thanks so much.